So guys, at our last discussion, we talked about the prospects of a rate hike from the Fed, and also some of the risks that possibly were building up in the markets and what could go wrong. For 2 years, all players in investment markets have been fixated on QE and monetary policy. But over the last few weeks, something has been changing. The rhetoric has changed and market pricing is changing a little bit. What's happening, Mark?
I think markets are starting to question as to whether monetary policy, maybe even central banks themselves are starting to question as whether monetary policy is actually now getting to the point where it's actually pushing against a string. We had the Bank of Japan meeting 6 weeks ago, late July, and they came out and pretty much underwhelmed the market with response as far as additional QE. They also announced that they would be doing a comprehensive assessment of monetary policy, QE, and the effectiveness of QE with negative rates. So putting a bit of a question mark out there as to whether the policy is working. More recently, last week, we had the ECB came out and also underwhelmed markets with regards to what they did. So I think the markets are starting to wonder if central banks are still as committed to applying the juice, you might say, that keeps investment markets inflated. And so that's what we've seen, a little bit of the jitters more recently in the equity market and a little bit more steepening in the bond market of late.
Yeah. Tano, your thoughts?
Well, I mean, look, it really comes down to after 5 or 6 years of quantitative easing across most of these jurisdictions, the central banks are really undershooting on their key objective, which is inflation. They're trying to get inflation up to a certain level. And then it's really because what's driving that is other factors, not just what monetary policy can control. These are supply-related factors, like weakness in productivity. So monetary policy is performing its function, but it needs help from other areas.
I would add to that buying bonds and getting the yields down to negative interest rates are having significant unintended consequences. We know that that banks really struggle to make a profit. In fact, they lose money when they go to negative interest rates. We're seeing that in their earnings, and we're getting strong feedback from large investors in Japan, the pension funds, the life companies, and they've been telling the BOJ directly that they cannot invest and they will not invest. Japanese Post Bank won't invest at negative interest rates. So the pressure is coming from traditional investors in markets that they're resisting as well. So chaps, what are the different levers that the authorities can pull if it's not just monetary policy?
Well, we've obviously seen a lot of central bank activity across the entire yield curve, and they've driven the yield curve down structurally across the entire curve, and they've been the big buyer, I guess, in that market. And as you say, that's put a lot of pressure on life cos, pensions, as well as the banking sector itself with regards to their investments in these longer bonds at often negative yields now, particularly in Europe and Japan, and that's hurting their investment earnings and therefore hurting their profitability, and also probably constraining their ability to lend and therefore the usual credit creation cycle. So I think all that sort of lends itself to put question marks as to whether negative interest rate policy is actually working, whether they can continue with it, but particularly at the back end, should 30-year rates be as low as they should, or does that create bubbles, or does it create sort of misallocation of resources? So I think that's been questioned. I think the other one that we've spoken about before is fiscal policy as well as structural reform and things that may be done in that space as well, which is obviously very topical at the moment.
Tano? Well, on monetary policy, one of the key benefits has been through what they call the portfolio balance approach, and it's really given rise to positive wealth effects. That's primarily how it's worked. But ultimately, there's a trade-off here, and the trade-off is financial instability. So we're seeing a bit of that at the moment, given this protective put that's coming from central banks and this heightened sensitivity of the market to what central banks do or not do in this case. So short of that, I think fiscal policy can play a key role, and then ultimately structural reforms across many of these areas I think will be far more important.
So just on fiscal policy, we've been talking for a long time that fiscal needs to kick in, but we're getting a lot of feedback from the key decision makers. Like after the recent G20 meeting, the communiques that came out were talking about monetary policy can only go so far and fiscal policy needs to kick in. But fiscal policy is much more political. Monetary policy is you can outsource it to your central bank and they do what they have to do. But with fiscal policy, you need consensus. Japan seems to have an easier run. I think the UK has an easier run on fiscal policy. Europe, it is going to be very, very difficult just by virtue of the contract and the reluctance to have fiscal transfers between surplus and deficit countries, etc. So, and then I'll just say in the US, both candidates for the election are talking openly about increasing fiscal spending. Now, this week ahead could be a huge week. Markets are bracing themselves. There's an excitement around. There's an excitement in pricing. We've had a lot of volatility. You know, the VIX has gone from about 8 to 18. A fair bit's happening. I'll just flag that the FOMC are meeting on the late in the week, and we're going to get outcomes in Australia on the 22nd. But possibly more importantly, on the 20th and 21st, the Bank of Japan are having their follow-up meeting where they are going to make the long-awaited decisions on maybe some tweaks to their QE program. I think markets are bracing themselves for volatility. How do we feel? And are there opportunities? I mean, what's the best bet for the coming week?
I guess there's always opportunities. I guess it's hard to know exactly what sort of announcements we're going to see come out of. The market's taken the view that maybe the Bank of Japan is going to wind back its long bond purchases, and that puts a little bit of pressure on the back end of the Japanese bond market and globally markets as well. We've obviously seen on the back of that, or I guess the ECB announcements or lack of announcements on late last week caused a bit of a mini 2-day taper tantrum with regards to equity prices and bond prices to some degree as well. So the market has actually shifted its thinking, and some of that's been priced in the market. The question mark is to whether the central banks will deliver market expectations or not, and that's always a hard one to play. But I think to your point, the market is playing around these volatility points, which is basically now central bank meetings and outcomes of central banks, which all gets to the point of central banks have been the big providers of liquidity to markets for so many years now. The question is now, are they going to continue to be that way, or are things going to change? So volatility is probably the main thing I can probably say that I think we're going to see.
Tano?
Well, I guess this is one of the side effects of QE. Central banks help suppress volatility in financial markets to get returns. You see more leverage, bigger bets, and then when the cat's out of the bag and you see more volatility rise, it begets more volatility, and then there's a deleveraging that has to take place. So that it starts to feed back on itself, and this negative feedback loop. So it's hard to know where it actually stops. But I would say, at the end of the day, the question you need to sort of resolve for yourself is, has the fundamental backdrop changed any?
Yep. Yeah, well, exciting week ahead, no doubt, and I think we're bracing ourselves. Looking forward to having a follow-up discussion in most probably in a few weeks' time.